but let me know whether you can hear me. Let me know whether you can hear me. Yes, I see David. You say that you can hear me. Yes, I can see a good number can hear me. Today's numbers are too low. I hope the rest will be joining. Yes, good evening. Yes, I can see that you are there. I want us to continue from where we left yesterday. We continue from where we left yesterday. The concept of forex market. I can see, I can see a good number. You can hear me. That is good. I see also people are still joining. We are at 40%. I hope the rest will be joining us. I want us to start. I want to put into understanding what we did yesterday. I believe yesterday we did a lot. Within a very short time, we did too much. And I know when there are so many technical issues, sometimes they can be confusing. I have therefore decided to embark on more illustrations so as to make you understand. I'll do more illustration before we move to the next item. At least we try to understand what we did yesterday before we can talk of anything new, anything in addition to that. So let us look at the first question. If you can see my screen, I have written practice questions, and I want to read through question number 1. It is a practice question. I hope you can see my screen. Please let me know. Can you see the question on the display? Let me see, even if it is one person to confirm for me. Can you see the question on my screen? Let me so know whether you can see it so that we can continue, so that I can, yes, thank you. I see that you can see the question, and I want us to look at it. Let me make it a little bigger for clear visibility. The question read, Granada Limited, a United Kingdom-based company, imports computer components from the Far East. The trading currency is the Singapore dollar, and the value of the deal is 28 million Singapore dollar. 3-month credit is given. The current spot exchange rate is Singapore dollar 2.8 to 1 euro. Due to recent foreign exchange volatility, the directors are concerned that a rise in the value of Singapore dollar may erode the deal profit. The following 3 hedging options are being considered. 1, a forward market hedge. 2, money market hedge. 3, an option hedge. Granada Limited Treasurer has provided the following information in respect to the deal. Number 1, the 3-month forward rate is 2.79 Singapore dollar per euro. Number 2, Granada Limited can borrow Singapore dollar at 2.2% per annum and euros at 5% per annum. Number 3, deposit rate is 1% per annum in Singapore and 3% per annum in Rwanda. Then we have a 3-month American call option to buy 28 million Singapore dollar at an exercise rate of Singapore dollar 2.785 per euro, can be purchased at a premium of 200,000 euros on the London over-the-counter option market. Required. Indicate which hedge is better between the forward contract and the money market hedge. 2. Evaluate the option hedge assuming the following future spot rates. Now, this question requires good understanding because we are not dealing with our respective countries. I wanted to drive a concept where once you understand the corporate finance, you understand the whole thing about the trading in the foreign market. And I want to read through this question again. Let me read through it again. Granada Limited, a UK-based company, imports computer components from the Far East. The trading currency is due to recent foreign exchange volatility. The directors are concerned that a rise in the value of the Singapore dollar may erode the deal's profit. The following three hedging options are being considered: forward market hedge, money market hedge, option contract hedge. Granada Limited Treasurer has provided the following information. Number one, the 3 months forward rate is 2.79 Singapore dollar per euro. Granada Limited can borrow Singapore dollar at 2% per annum and euros at 5% per annum. Deposit rate is 1% per annum in Singapore and 3% per annum. Let me replace this to UK. So, Granada Limited can borrow Singapore dollar at 2% and euros at 5% per annum. Deposit rate is 1% per annum in Singapore and 3% in UK. A 3 months American call option to buy 28 million Singapore dollar at an exercise rate of Singapore dollar 2.785 per euro can be purchased at a premium of 200,000 euros in the London over-the-counter option market. Required. Indicate which hedge is better between the forward contract and the money market. Between the forward contract and the money market. In such a question, the first thing you ask yourself, which country is foreign, which country is domestic? Is the deal an import or an export? And the third question, is it a direct quote or an indirect quote? Those are the three questions that you should always ask yourself when answering question on foreign exchange. Which country is foreign and which one is domestic? Is it direct quote or indirect quote? Is it a deal to export or import? If I could read again, tell me these questions. Granada Limited, a UK-based company, imports computer components from the Far East. The trading currency is the Singapore dollar, and the value of the deal is 28 million. 3 months credit is given. The current spot rate is Singapore dollar 2.8 to 1 euro. Due to recent foreign exchange volatility, the directors are concerned that a rise in the value of the Singapore dollar may erode the deal's profit. The following three hedging options are being considered: forward market hedge, money market hedge, and option. Granada Limited Treasurer has provided the following information. 1. The 3 months forward rate is Singapore dollar 2.79 to euro. Granada Limited can borrow Singapore dollar at 2% and euros at 5%. Deposit rate is 1% per annum in Singapore and 3% in UK. A 3 months American call option to buy 28 million at an exercise rate of 2.785 to euro can be purchased at a premium of 200,000 on the London over-the-counter option market. I want us to start with the forward contract hedge. If I could have it here, let me start with the forward contract hedge. But I need you to tell me the nature of the problem that we are dealing with. Which one is domestic country? Which one is the domestic country? And which one is the foreign country? I want to display it so that you can look at it and tell me which one is the domestic country and which one is the home country. Look at it and tell me. Which one is home country? Which one is the domestic country? Let me see what people are saying. UK is home, domestic is UK. Another one says it is Singapore. We have two saying it is UK and one saying it is Singapore. Let me hear. Who else? UK is home, UK is home, UK is home. So the majority says that the UK is home while Singapore is the foreign country. We got the Singapore in Singapore dollar, and the United Kingdom is the home country. Now, the question is, if UK is, the trader is in UK, my question is this a direct quote or an indirect quote? That is the next question. Is this a direct quote or an indirect quote? I want you to tell me, is this a direct quote or an indirect quote? Direct quote or indirect quote? Indirect, someone says indirect, another one says direct. I think you are alternating direct, indirect, direct, indirect. Is it a direct quote? Is it an indirect quote? Let me see the other group. Indirect, 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 indirect. Indirect quote, indirect quote. Good. I think this one is this brainstorming will make us understand. Now, Granada Limited, a UK-based company, imports computers component from the Far East. The trading currency is the Singapore dollar, and the value of the deal is Singapore dollar 28,000. 3 months credit is given. The current spot exchange rate is 28 to 1 euro. The current spot exchange rate is Singapore dollar 2.8 to euro. Due to recent foreign exchange volatility, the directors are concerned that a rise in the value of the Singapore dollar may erode the deal profit. The following 3 hedge options are given. Down there we are given the 3 Granada Limited can borrow Singapore dollar at 2% and euros at 5%. Deposit of Singapore in Singapore is 1% and UK is 3%. Now, from where we stand, number one, we need to agree on a number of things. The domestic currency, the domestic country is the UK. The quote is, let us see. If we are in UK, Granada Limited, a UK-based company, imports computer components from the Far East. The trading currency is the Singapore dollar, and the value of the deal is 28 million Singapore dollar. 3 months credit is given. The current spot exchange rate is 2.8 Singapore dollar to 1 euro. The amount of foreign currency per unit of the domestic currency. Let me check this thing. Granada Limited, a UK-based company, imports computer components from the Far East. The trading currency is Singapore dollar, and the value of the deal is 28 Singapore dollar. 3 months credit is given. The current spot exchange rate is Singapore dollar to euro. Due to recent foreign exchange volatility, let me see down there. We are told that the 3 months forward rate is Singapore dollar to euro. So the question is, indicate which hedge is better between the forward contract and the money market hedge. Is this thing really correct, or are we missing something? Let's try to interpret it well. Otherwise, we might get ourselves in trouble about it. When you look at it, we are given the transaction amount as $28, and we need to determine the amount in euro. The UK. Oh yeah. If this trader is in UK, then UK becomes the home country. So we are given, are we really getting it right? The current spot exchange rate is, the foreign currency per unit. Oh yeah, it is in direct quote. The transaction is in direct quote. I hope quote. It is in direct quote because we are given the amount of foreign currency per unit of the domestic currency. Then we are told that Granada Limited, a UK-based company, imports. The transaction is an import. The transaction is an import. The transaction is an import. Now the question is, under the forward contract hedge, how much money will be realized in euro? Look at note number 1. The 3 months forward is Singapore dollar 2.79 per euro. So how much is the amount that will be realized given that exchange rate? I want someone to give me that. I want someone to give me the answer to that. How much will be realized in the UK in euro? Someone to give me how much will be realized in euro at a forward exchange rate. That is at a forward contract hedge. Someone to give it a trial so that when we discuss, you understand. Okay, someone to give me from where you stand. I want to see. This is an indirect quote. We need to report in euros. Let me display the way it should be so that at least we understand, not necessarily to finish, but to understand. Let's say we are told that the quotation, the forward 3 months exchange, 3 months forward rate. I want to give it this way: 3 months forward exchange rate. We are giving the Singapore dollar to euro, the Singapore dollar to euro. Okay, let me Singapore dollar. I want to show you. I want to explain it in a way that we'll understand. Singapore dollar to euro. Oh, sorry. Singapore dollar 2 point something, 2.79, 2.79 to euro. Then here we are told transaction size is equal to the Singapore dollar 28 million. Then we say that the amount in euro, amount in domestic currency, amount in domestic currency is equal to this Singapore dollar, like that. We divide by this. How much is it now? How much is it now in euro? Okay, someone to give it from there. Someone just post on the chat box. Someone give 10,035. Is that what you've given? Is it 10,035 482.293? That is the amount that will be realized in if the hedge was forward contract hedge. Number two, the money market hedge. Let's see what happened when it comes to the money market hedge. Money market hedge. Money market hedge. Let's go for the information on money market hedge. This is money market hedge for an importer. The transaction size is 28 million. The current spot exchange rate is 2.8 million. And we are told that Granada Limited can borrow Singapore dollar at 2% per annum and euros at 5%. Deposit rate is 1% per annum in Singapore and 3% per annum in UK. From that information, can you try to relate what we discussed yesterday with what we are talking about? Using this information and considering that we have the transaction size is 28 million, we have a spot exchange rate of 2.8. Can you try to argue out? Just look at it for 2 minutes before I can explain to you. Let me explain the money market hedge so that, remember, the transaction here is an import. And I will give it the deepest explanation so that we can understand. We say that the trader has a liability from credit importation. The trader has a liability from credit importation of Singapore dollar 28 million. Like that, of 28. Now this trader, the trader should therefore create an asset. The trader should create an asset by investing in the money market, by investing in the money market. My question is, how much is to be invested? How much is to be invested? When you look at it, how much is to be invested? Let's go back to the question. We are told that if you look at this point, deposit rate is the investment rate is 1% per annum in Singapore and 3% in UK. Because the transaction is in Singapore dollar, we need to get investment rate. Investment rate is equal to 1% multiplied by 3 months, 3 months over 12. How much is that, please? One percent times 3 over 12. What percentage is this, please? Let me get from someone. There's someone who says that the wrong number. I don't know whether it is the answer that we wrote up there. I don't know whether it is the one. The person who says it is wrong number, can you clarify whether it is that one and how much is the correct one? Someone has given me 0.25. So the amount to borrow, please confirm whether this figure was correct. I don't know whether it is the one that you are referring to as wrong number. Amount to borrow, to invest is the present value of the transaction amount. Transaction or the liability amount, which is equal to Singapore dollar 28, this one, Singapore dollar 28. We discount it at 1 point, this is 0.25, 1.0025 power negative 1. How much is the amount to be invested? How much is the present value of that? I see someone says that the amount we put is correct. So I don't know what could have been the problem. Okay, so what is the present value? The present value, let us see what you have. Let's see what you have. I can see someone has given a value. I've just copied what you have sent. 27,931.74.56. Please confirm whether that is the figure. If this is the amount to borrow, I'll just put it here. The amount that need to be invested today. That is the amount that need to be invested. Now, the amount to invest is borrowed from UK and converted to Singapore dollar at spot exchange rate. So the amount borrowed is therefore equal to, for us to get the 27, the conversion rate was the spot exchange rate. How much is the amount in euro? I'll pick this one. Then I divide by the spot exchange rate. The spot exchange rate is somewhere here. the spot exchange rate. This one. This is the spot exchange rate. I'll come and divide with it here. Divide by that. Allow me to make it look good. That way. Like that. How much is the amount now in euro? Let me have it in euro. How much is euro? Okay, let me have it, and please make sure that it is very accurate. Let me have that figure. Let me have it in euro. Someone give 97 something. I'll just copy it the way it is, the way you have given it. Is it confirmed to be that way? Can you confirm? Is that figure confirmed, please? Okay, assuming that this is the correct figure, let me see whether there's anyone who is of contrary opinion. Yeah, it is correct. Yeah, it is correct. The argument is this amount is borrowed at in UK, the borrowing in euro is at a rate of, it is at a rate of, how do we borrow in UK? We had a question. We always use power -1 to get present value, or we use it if hedge period is in months. It is to get the present value. Remember, we first convert the rate to a period of 1 period. That is why we are taking power -1. I don't want to use the alternative way, which could be a little complicated. So I decided to use it directly. Just convert it to proportion to the period. Then use power -1 and the power 1. That is the easiest way. Someone is giving us, is it 1.25%? I see someone here has given us 1.25%. I believe it is that way. If this is the case, the amount payable at end of 3 months is equal to this amount that is borrowed, the amount borrowed here, we multiply by 1.0125 power 1, like that. How much is the amount that will be borrowed, will be paid at the end? Someone to give us the amount that will be paid. Someone says that the figure we are using is understated. Which one? Which figure is that? David, which figure do you say is understated? And if yes, which one is the correct figure? Someone is giving the present value of 28 is 27.9, that 174. 27.9, that 174. The present value. $27.9, that 174. That's what we are using. This one. $27.9, that 174. I want us to be in agreement. So, do we agree on this amount? 975,062 times 34. Is it 980? How much is it? Make sure that you move together, please. The amount to be borrowed from UK is not correct. Do you mean this one? This one? Please, please, please. Let me know. The 27,930 174.56 divided by spot exchange rate of 2.8. How much is it? How much is it? Let's first solve that one. How much is the amount borrowed? Let's see how much is the amount borrowed. 9975. Let me check this one. 9975,062. 9975 is said this way. 99. Can we confirm this? Please, please, please. So that at least we move together. Is it 9975,062? That is correct. Someone says that. 970. Is it? Hey, you are giving different figures. You are even confusing me. There are those who are saying it is 10. There are those who are saying it is 99. There are those who are saying it is 98. There are those who are saying that it's 97, which is which now? Please, 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 let us use the correct figure. You have it here. 27,930 174.56 divided by 2.8. How much is that? Let us first solve that. Do I go with 99,75,062? 99,75,062. I hope That is the correct figure. That is the correct figure. Like this. 9975 062 point. Yeah, I think that is what you have settled for. Okay, then give me the future value, the amount that will be paid, because you borrow today 9975 062.345, you compound it at 1.0125. Let me have the amount that is payable. Someone is giving 10, 10, 10, 10, 10, 099. Let's see whether there is another one. 10, 099, 750, something like that. Okay, let me put this figure here. 10, 099, 750.62. I've just copied it the way you have shared, so that at least I don't make a mistake. I hope that is the amount, 10,099, 750. 10,099, 750. Let's now try to compare the two. Under the money market hedge, this individual will pay this much. Will pay this much. Like that. Under the forward contract hedge, this individual will pay this much. Will pay this much. 10,035 and 10,099. Then it means the forward contract hedge is better for this trader. Is better for this trader because the trader pays less. 10,035. 10,035. That is what the question was all about. And I think we have taken it step by step to help us understand. Unless someone has a question before I move to the next part of the question. And the next part of the question is about, let me go back to the question. The next part of the question is, evaluate the option hedge assuming the following future spot rates. Before I explain the futures, let me, not the futures, the options. I want someone to ask a question if you have a question. Yeah, forward contract is better, is preferable, it is cheap, it is better. Let me explain the option contract hedge. Options contract hedge. Back to the question. Look at the way the question is framed. There is somewhere we are told about options. Note number 4. Note number 4. A 3-month American call option to buy 28 million Singapore dollar at an exercise rate of 2.785 per euro can be purchased at a premium of 200,000 euro in the London over-the-counter options market. Evaluate the option hedge assuming the following future spot exchange rate. Let's try to summarize the option contract hedge. Let us summarize it here. Options contract hedge. Options contract hedge. We say that the exercise exchange rate is equal to Exercise exchange rate is this one. Exercise exchange rate is this, like that. Exercise exchange rate is Singapore dollar 2.785 to euro, like that. Then we have the premium is equal to, we have the premium is equal to 200,000 euros. If I have the correct figure, then if that is the case, the premium is that much. We look at scenario one. Scenario one, exchange rate is equal to, the exchange rate is equal to we are told, suppose the exchange rate is equal to 2.7. Like that. My question is, here we have the exercise exchange rate, and here we have the market exchange rate. Exchange rate, I will use the word market exchange rate. My question is, should this trader exchange at the market or at the exercise exchange rate? Which one is preferable for this trader? Should the trader go for the market exchange rate or the exercise exchange rate? Let me see what you are saying about that. Market exchange rate or the exercise exchange rate? Tell me. Should this trader go for the market exchange rate or the exercise exchange rate? Someone says market exchange rate. Another one says exercise exchange rate. Today, I'll make sure that you understand this thing. Don't worry. That's why I'm not in a hurry. Exercise exchange rate, market exchange rate, market is better one. Exercise exchange rate, market, oh, you are alternating market, exercise. That tells me that we haven't gotten correct what is the meaning. The question would be, which one will make this trader to pay less? Which one will make this trader to pay less? Is it the exercise exchange rate or the market exchange rate? Which one will make this trader to go to the market, to go to the bank with less of euros? Is it exercise exchange rate or the market exchange rate? I hope that question I have reframed it well. Market exchange rate, exercise exchange rate, exercise exchange rate, exercise exchange rate, exercise rate, exercise rate. Let's see. Remember, this is an indirect quote. We are taking 28 million divided by the exercise exchange rate. The exercise exchange rate is 2.785, 2.78. So the trader will, let me put it this way, the trader having the right will opt for the exercise exchange rate. So amount payable is equal to the Singapore dollar 28 million Singapore dollar 28 million. When this person receives Singapore dollar, it needs to pay Singapore dollar 28 million. They require to have how much? Divide by this. How much in euro will this person be required to have, or this company be required to have? Market, someone is asking, where did we get the market exchange rate? It is given in the question. We are given two options, two market exchange rates. So we are evaluating the first one. Someone is giving me 10,053. I don't know whether that is what you people have. Ten zero 53, yes. So if the market exchange rate happen to be 2.78, this trader will go for the exercise exchange rate. Now this is scenario 1. That was scenario 1. Let us go for scenario 2. Scenario 2 here. Scenario 2. The market exchange rate, if the market exchange rate is instead this, if the market exchange rate instead is this one, how much will this individual pay, or will this company pay? 2.8. Will this trader go for the market, or will they go for the exercise exchange rate? If the market exchange rate is 2.82, will this trader go for the market exchange rate? Okay. Before that, there's something I've remembered. You are not reminding me that there was premium. There was premium. Amount payable is that. That is correct. At premium paid. This one we're given the premium was how much? So the total amount paid is equal to the euro how much is the sum? This should be euro 10 0253 10 253 859.96 859.96. This company will have paid a premium plus the money that will be needed to settle the liability. That is it. Now we look at scenario 2. If the exchange rate is this much, if the exchange rate, the market exchange rate is this, what should the trader go for? The trader having the right will opt for market rate or the exercise exchange rate. Someone, he will go for market rate. One person says market rate. Go for market rate. Another one says for market rate. Market rate, market price, market rate. Yes, it is market exchange rate. The market exchange rate. Then from there, I can just allow me to copy these ones. These ones. Then I'll come down here and do some changes. 28 divided by the market exchange rate is 2.82 or something. 2.82. How much is this? 28 million divided by 2.82. Let's have the figure, please. They will go for the market rate because with the market rate, the amount payable is less. They will pay less. Let me see the amount. How much is it? 99,29,078. 99,29,078.014. I think I see a majority giving this. How is this figure? Let me see whether is it that way. How much is this? $99.29. Is it that way? Is it 99,29,078.14? If that is the correct one, add the 200,000. Add 200,000. How much is it with the 200,000? There are questions that are coming. Someone is saying deduct premium. Another one is who pay premium. The other one says that he think that you have confused the quotation. The other one says that not correct. You overwrite. Now which is which? So many questions that are coming out. The premium is paid by the trader to the bank. The premium is paid by the trader to the bank. You will pay the premium and also you will pay for the imports. You are paying two things. Premium to secure the right for the import because you imported on credit. Unless someone has something different to that. So is the amount 10,129 the one I see here? Someone has given 10,129. 10,129 078.01. Is that confirmed? Maybe 014. Is that confirmed, please? I want us to know whether we are together. I've tried to move slowly so that at least we can understand. Yes. Please, the person who is asking about discount, please, can you read? Because we have so many things that we did. There is no discount in options. There is no discount in options. We are evaluating option. Don't mix things. We are on options contract hedge. Options contract hedge. We are on options contract hedge. There is no discount in options. The discount are found in forward, in premium, in spot exchange rate when you are determining the forward. And I believe that is what was needed. The total amount payable, that question have explained a number of items. I want to explain further, and this time I want us to look at another question. Let us look at another question. If you can see my screen, look at my screen so that we move together. Look at my screen, we move together. I want to read. Are we together? First confirm whether we are together to move. Can we move? Can you see the question? Okay, if you are together, let me demonstrate the next question. The question read, Kazenga Limited is a Rwandan company with a substantial proportion of its trade with companies in the United States. Kazenga Limited invoiced a United States firm 60,000 United States dollar receivable 3 months from now. Additional information. The borrowing rate is 3% above the bank base rate, while the investing rate is 2% below the bank base rate. These rates apply both in Rwanda and the United States. 2. The bank base rates in Rwanda and in US are 15 and 10% per annum respectively. The exchange rate in the forex market between Rwandan francs and the United States dollar are as follows. Rate type, Rwandan francs to USD, spot exchange rate, 1 month forward rate, 3 months forward rate required. Calculate the amount to be received by Kazenga Limited using forward contract hedge, money market hedge. Using the results obtained in A1 and A2 above, advise the management of Kazenga Limited on the best hedging strategy. Before we go to the question, remember there are three things we said. We should always ask ourselves, look at that question, tell me, is it a direct quote or indirect quote? That is one. Number two, is it an import or an export? Is it a direct quote or an indirect quote? Is it an import or an export? And which country is the domestic country? Those three questions, I'm looking at the chat box to see. Tell me, direct quote or indirect quote? Is it import or export? Which country is the domestic country? Okay, let me see. Let me see what you people are saying. Someone says that export, domestic currency is Rwanda, direct quote, export. Uh, Direct quote, export, domestic is Rwanda. That helps us to understand the question. So we are told that Kazenga Limited is a Rwandan company with a substantial proportion of its trade with the companies in the United States. Kazenga Limited invoiced US firm 60,000 United States dollar, receivable 3 months from now. Additional information, the borrowing rate is 3% above the bank base rate, while the investing rate is 2% below the bank base rate. These rates apply both in Rwanda and in the United States. The bank base rate is Rwanda. The bank base rate in Rwanda and the US are 15% and 10% per annum respectively. The exchange rate in the forex market between the Rwanda francs and the United States dollar are as follows. Spot exchange rate, 1 month forward rate, 3 months forward rate. Then we are told required. Calculate the amount to be received by Kazenga Limited using forward contract hedge. I want you to answer the first question. How much is receivable? It is home country is Rwanda. The quote is direct. And this is an export. Give me how much is receivable in Rwandan francs at the forward contract hedge. Look at this question the way it is. Give me the answer for the forward contract hedge. Put it in your calculator so that when I explain, you will understand it. Put it in your calculator. Give me the answer. How much is payable in forward, is receivable in forward contract hedge? How much do you have? I'm waiting to see forward contract hedge. Let me see what you have. 60,000. 60,000. Another one 6120. 60,000. 6120. Let us see. We have more who are saying 60. 60. I think a majority says 60. Let's see who else has computed. So majority says 60. 60 is the one that is coming out. Everyone is 60. Let us see. Let's go back to the question. The transaction size is 60,000 United States dollar. Let me try to argue it out. The solution, number one, forward contract hedge. Contract hedge. The trader will sell the USD to the bank. The bank will buy at the lower exchange rate rate since this is a direct put. We are given 3 months forward rate is 1.1. So the amount realizable is equal to USD 60 multiplied by the Rwandan francs 101 US dollar. Is this the one that was giving me the 60? Is this the one that was giving you the 60? I think that one was direct, and I believe that is what it is. The other question is money market hedge. Money market hedge. At least that one has shown that people are understanding money market hedge. Money market hedge. Let's look at the question again. Money market hedge. I want you to look at this question. We are told that let me give you a chance to prove yourself. Can you give me the answer for the money market hedge? Money market hedge. Please compute before I come in. It is better when you compute, you understand it better, so that when I explain it, it becomes easier. Okay, compute the money market hedge. Take 5 minutes to compute the money market hedge so that when I explain, you will understand it better. How much is realizable on money market hedge? 5 minutes. So I see one person has given 61,060. Is there any other one who has finished? There is a 59. I want to see quite a number so that when we look at it together, you will understand better. Let's see another one. You have 61 and you have 59. $61 is 6 million, 59 is only 59,000, so that variance is too big. I'm waiting for you to give me the answer so that we can compute it together. You understand it better when you attempt, then when we solve together, it will be better for you. I see another 61, 64. Yeah, it seems that there are people who have something they can light. I think there's another one, 63. 63. That's good. That is encouraging. So let us work on it together. Let us work on it together now. We see what would be the outcome. Money market hedge. Money market hedge. This is, we are told that Kazenga Limited invoiced a US firm. That means is an export. Since this is a credit export, the trader has a asset, has an asset. Therefore, the trader should create a liability by borrowing in the money market. By borrowing in the money market. The transaction size is 60,000 USD, and we are told that the borrowing rate is 3% above the bank rate, while the investing rate is 2% below the bank base rate. These rates apply to both countries. The bank base rate in Rwanda is 15, and the one in US is 10. This person will borrow, let's see, the amount here is given in USD. The transaction size is USD. Transaction size is USD 60,000. 60,000. That is the amount receivable. Amount to borrow, borrowing rate is equal to borrow in USD. Borrow in USD. The borrowing rate is 3% above the bank rate. 3%. And the bank base rate in US is 10. So it should be 13%. But this is 3 months over 12 multiplied by 13%. How much is the borrowing interest rate? Let's have the borrowing interest rate. Borrowing interest. Someone is saying it's 15. Is it 15? Let's see. Let me go back to the question. This person is borrowing in Rwanda, in Dora. The borrowing rate is 3% above the bank rate, while the investing rate is 2% below the bank rate. This rate apply both in Rwanda and the United States. The bank base rate in Rwanda and the US are 15 and 10. 10 is in US. And if it is in US, it means it is in US dollar. 10 is USD. We take 10 plus 3. How much is 3 over 12? 3 over 12 times 13%. Someone, please. 3.25%? Oh yeah, 3.25%, I see. 3.25%. So they will borrow at 3.25%. So the amount to borrow is the present value of the trade receivable. Which is equal to the US dollar 60 multiplied by 1.0325 power negative 1. How much is the amount to borrow? Give me the amount to borrow, the present value. Someone says 58,111. Can we confirm whether that is correct? $58,111.38. Please confirm. Someone is asking, could you explain a bit the... Okay. I think you are talking about the issue of borrowing and investing rate. Let me explain that one. Let me explain that. I know from this question it can be confusing, and I want you to understand. You are confirming that the figure is correct. Let me go back to that question so that at least we can move together. Look at the way the statement is said. Additional information number 1, the borrowing rate is 3% above the bank-based lending rate. When you go to the money market and borrow, you will borrow at 3% below the market, above the market rate. When you invest, you will earn at 2% below the market rate. I know the confusing part is number 2. The bank base rate is in Rwanda, and the US is 15 and 10 respectively. 15 is for Rwanda and 10 is for US. That means when you are told for Rwanda, it is that for Rwandan francs. When you are told for US, it means the US dollar. It stands for the US dollar. That could be the main confusion, because you are not told whether it is borrowing the dollar or the Rwandan francs. The reference is to the currency of the respective country. That should be the point that we need to understand. The reference is to the currency of the country. Having gone through that and having agreed that the amount is USD 58, we go to the next thing, convert the borrowed amount to the Rwandan francs at the spot exchange rate. Now, this is a direct quote. Spot exchange rate, spot exchange rate. If we went back to the question, we are given a spot exchange rate of this. Rwandan francs to the USD. Rwandan francs to the USD will be put here. Okay, let me do this. Rwandan francs to the USD is 103 to 105. Amount to realize is equal to, this trader will take the money, the 58 USD to the bank, this amount to the bank, this amount will be taken to the bank will borrow, so it will buy at this. That is the value at which the bank will buy. How much will be realized in Rwandan francs? How much will be realized? Someone is giving me how much? 59.85. Okay, then invest the amount in Rwandan francs in the money market over the credit period. Investment rate is equal to, we are told that the rate of investment is 2% below, and because it is in Rwandan francs, the bank base rate in Rwanda is 15 minus 2. 15 minus 2. This is 3 months over 12 multiplied by 15 minus 2. I think we need to note that this is 15% minus 2%, so that we may not confuse with the other one. How much is 3 over, I think this one remains the same, 3.25. 3.25%. Then determine the amount realizable at end of 3 months. This is equal to this amount, the amount invested in Rwandan francs. We multiply by 1.0325 power 1. How much is that? Give me the amount in Rwandan francs. How much is it? Someone is giving us 61 something. Like that. 61,79,999.999 whatever. So it is 61,80,000. 61,80,000. And if that one is correct, that is the amount payable in that question. And that one is money market hedge. Then number 3, using the results obtained in A1 and A2 above, advise the management of Kazenga Limited on the best hedging strategy. They will realize 61.79 in the money market and realize 60 in the forward contract hedge. That makes the money market a better option. The money market hedge gives a higher amount. Hence, it is preferable. It is preferable under the circumstances. It is preferable under the circumstances. We have tried to explain that question in the very best way, and I want to give you a chance to ask a question. If there is a question, ask a question. If there is a question, I need to see whether there is a question before I can demonstrate. That one was meant to demonstrate the issue to do with forward contract, the forward contract hedge and the money market hedge for importer. The other one explained the option, the forward, and the money market hedge for importer. You will note that they have different concepts. Someone is asking, the issue is to know direct and indirect quotes. That one, use the note where I wrote the quotation, how we define the quote. That is where the main key, the point is. Who made investment and borrowing between debtor and the creditor? All this is being done by the trader. This one is being done by this exporter because the exporter is the one who is hedging. The exporter will go and borrow. The exporter will go do the investment. It is the trader. It is the trader who will do that. I think I explained that issue of borrowing, buying at higher exchange rate. I said for a direct quote, the bank will buy low and sell high. In an indirect quote, the bank will buy high and sell low. And I made sure that I wrote that one so that you don't ask that question. That is what determines the profit of the bank. I want us to move to the next question. We try to explain a different concept and insist on the concept that we've talked about before we can discuss about anything else. And before then, I think we can take a few minutes break. Let's take a break. Let's take a break. Let's take some 10 minutes. We take some water. It is 7:32. 7:32. Let's take 10 minutes break before I take you to the next item. Just take a break, please. At the low rate for the currency in case of a direct quote. When you are buying the currency from the bank will sell to you at high exchange rate. So in a direct quote, the bank will buy at low exchange rate, but will sell at high exchange rate. In an indirect quote, the bank uses the high exchange rate to buy and uses the low exchange rate to sell in an indirect quote. That is the very best way to go about the question being asked here, to explain when to use high or when to use the low exchange rate. I hope that is what you wanted. The other question, where is there any other question? Can you explain that additional information one in details? Which is that additional information one? Additional information one was about what? The borrowing rate. Okay, that is just a statement that will be given in a question. The borrowing rate is 3% above the base rate. That one relates to note 2. Because if you want to know the borrowing rate, you take this. For Rwanda, you add 15. For US, you add 3 to 10. The investing rate is 15 for Rwanda minus 2. And the one for US is 10 minus 2. So it is just a unique state based on the question, the way the question is framed. That I think is the question that you're asking. Okay, let me see whether the other question can give us some more insight. Let's go to the next question. It will give us some more insight. Look at the question. Kikope Limited, a Rwandan company, has a substantial proportion of its trade with Ugandan and Tanzanian companies. It has recently invoiced a Tanzanian company the sum of Tanzania shillings 5 million receivable in 1 year time. The firm is considering the possibility of hedging using the following methods. Method 1, use of money market instrument. Method 2, use of forward exchange contract, where the spot exchange rate is 12 and the 12-month forward exchange rate respectively are spot 1 Rwandan francs to Tanzanian shilling and forward Rwandan francs 1 to Tanzanian shillings. The annual interest rates are as follows. Tanzania is 3.5%, Rwanda is 5.75%. Required net proceeds in Rwandan francs under both methods. 2. Based on your answer in one above, advise the management of Kikope Limited on more advantageous method of hedging among the two. The question is, Kikope Limited, a Rwandan company, has a substantial proportion of its trade with Uganda and Tanzania companies. It has recently invoiced a Tanzanian company the sum of Tanzanian shillings 5 million receivable in 1 year time. The firm is considering the possibility of hedging using the following method. Method 1, use of money market instrument. Method 2, use of forward exchange contract, where the spot exchange rate and the 12-month forward exchange rate respectively are spot 1.4455 Rwandan Tanzania shillings to Rwandan francs, and forward is 1.4165 Tanzanian shillings to Rwandan francs. The annual interest rate are Tanzanian shillings is 3.5 and Rwanda is 5.75. The question is, net proceeds in Rwandan francs under both methods. Based on your answer in one above, advise the management of Kikope. Now, first things first. Can someone give me how much? Okay, first things. Number 1, is this a direct quote or indirect quote? That is question number 1. Number 2, is it an import or an export? Question number 3, which one is the domestic country? Always ask your question, yourself those 3 questions. Can you post the answer? Which one is the domestic country? Is it import or export? Is it a direct quote or an indirect quote? I need to see, please. Domestic is Rwanda, indirect, export. That is one person. Home country is Rwanda. It is an export transaction, direct quote. That is another one. Try it so that next time you'll know whether you are doing it right. Direct quote and export. Another one says indirect quote. Another one says direct quote. Home country is Rwanda. It is export. Direct export. Direct export Rwanda. Direct domestic is Rwanda. Okay, let us see. Let's look at it and see what we would say together. Okay, let's look at it together, jamani. Tuone. Kikope Limited, a Rwandan company, has substantial proportion of a trade with Uganda and Tanzania companies. It has recently invoiced, meaning export. A Tanzanian company, the sum of Tanzania shillings 5 million receivable in 1 year time. The firm is considering the possibility of hedging using the following methods. Method 1, money market. So the home country is Rwanda because it is the one that is trading. The quote, we are told that the exchange rate is 1 Rwandan francs to 1.44 Tanzanian currency. 1 Rwandan francs to 1.4165 Tanzanian currency. That is where the problem is. Is it a direct quote or indirect quote? Is that a direct quote or an indirect quote? 1 unit of domestic currency per unit of foreign currency. I want to see, is that direct or indirect? 1 Rwandan francs to 1.4 Tanzanian shilling. We must get this right. Still we have some direct, some indirect, some direct, some indirect. Some direct, some indirect. 1 unit of domestic currency per a number of units of foreign currency. Please try to argue it out, because this is the only area that you can make things bad or good. From what we defined yesterday, a direct quote is the amount of domestic currency per a single unit of foreign currency. That is direct quote. An indirect quote is the amount of foreign currency per unit of domestic currency. So when you talk of 1 Rwandan francs per, that is 1.4 Tanzanian shillings per 1 unit of Rwandan francs. From what I have said, what is the direct, what is this quote? Is it direct or indirect? Indirect, indirect, but still we have indirect, direct, indirect, direct, indirect. Is it the grammar that is difficult, or what is it? 1 unit of domestic currency, or the unit of foreign currency per 1 unit of domestic currency, we say the quote is indirect. And therefore, this quote is indirect. This question gives an indirect quote. The quote are quoted indirectly. In fact, I have explained that being so detailed. Now, if this is the case, let us start with the money market hedge. The money market hedge, we are told that this is an export. Actually, this one you should answer, so that at least I see whether you people are understanding. The trader has exported goods worth worth how much? Tanzanian shillings 5 million. Worth Tanzanian shillings. Tanzanian shillings 5 million. This is amount receivable. This is amount receivable. I want you to give me the answer. Please, give me the answer for money market. Give me the answer for the money market hedge, please. Compute that. Do the money market hedge. Very fast, very fast. 5 minutes are enough. Very fast, very fast. Give me the answer for the money market hedge. How much? How much is it? How much is it? I see some people have posted some figures. Let us work on it together. For the sake of the clarification and the sake of those who still don't understand how we go about it. This one is a money market hedge where we have an indirect quote. Money market hedge, the trader has exported this much. Let us see. The trader need to create a liability. Need to create a liability from things there is an asset. Borrow Tanzanian shillings at 1 year interest rate, which is equal to the borrowing, the annual interest rate are 3.5% in Tanzania. 3.5%. Borrow at 3.5. In simple terms, it is 1/1 times 3.5, which is 3.5. Remember, in the month we were expressing the period, credit period over 12. But this one, it is 1 year, 1/1 times 3.5. This is the borrowing of Tanzania shillings from Tanzania at Tanzanian shillings. What is the amount to borrow? Amount to borrow is the present value of the transaction size of the transaction size, which is equal to Tanzanian shillings 5 million. We multiply by 1.035 power negative 1. Power negative 1. How much is that? How much is the present value, the amount to borrow? Amount to borrow. I see people gave answers. We will compare the final answer, but tell me how much is the amount to borrow? Present value of the Tanzanian shillings at that rate. Let me see how much is the amount to borrow, the present value. 50,000 times that is equal to, yeah, I see 48 something. Let me just copy this one. That is the amount. Tanzanian shillings 48, that at spot exchange rate. At spot exchange rate. So amount, which is equal to Tanzanian shillings. That we need to convert at the spot exchange rate. Spot exchange rate is 1 Rwandan francs to Tanzanian shillings. This spot. So we'll take this one, divide by Tanzanian shillings, that per Rwandan francs. Give me this. 48,3917.874 divided by the Tanzanian shillings 1.445. That will give us the Rwandan francs. How much is it in Rwandan francs? How much is it? Someone is giving 3 point something. I can pick this one and press it here. 33,42039.34. That is the Rwandan francs. Then invest the borrowed amount. Invest the borrowed amount at the annual interest rate. The annual interest rate, which is equal to, what is the investment in Rwanda? The annual interest rate are Tanzania, then we have Rwanda, 5. We don't have any other information. So Rwanda is 5.75. 5.75%. So amount to realize at year end is equal to that amount multiplied by 1.0575 power 1. Power 1, because it is a single period. Rwandan francs, how much? Give me the amount. $35.92. Is it? $35.92. Some says 35.92. Like that. That's the amount that will be realized. Check whether what you had gotten earlier is correct. If there is the one that you had done, just find out whether it is correct. Then we have the forward contract hedge. Forward contract hedge. forward contract hedge. So the question reads, the forward exchange rate is this. Forward exchange rate. Forward exchange rate. How much is the amount realizable? Realizable is equal to Tanzanian shillings 5 million divided by Tanzanian shillings this per Rwandan francs. How much is the amount realizable? Someone to give me. How much is that? That 529? Please confirm so that we can agree on a single figure. That 529? Yeah, so that I think is what is realizable. And the question was, based on your answer in one above, advise the management of Kikope Limited on the more advantageous. Which one is giving them a bigger amount? That 592, that 529. Money market hedge gives a more amount. Money market hedge gives a higher amount. Hence, it would be preferable. It would be preferable. The money market hedge would be preferable because it is giving us a bigger amount. I want you to ask a question before I take you to the next item. Today I wanted to be a little slow so that at least you can understand the concept. When we be looking at the structured question from the past papers, it should help us understand. Ask a question. Okay, so that one I've taken the time to make you understand. I've given you even time to test yourself. Someone says that money market realizable amount is incorrect. What is the correct amount? Can someone explain to me why this was indirect quote? Because it is the amount of Rwandan francs per, the amount of Tanzanian shillings per unit of Rwandan francs. That is the reason. Because it is given as amount of Tanzanian shillings per unit of Rwandan francs. Not realizable in money market. It is okay. Someone has given us the one for money market. The correct amount is okay. The one in money market. Is it 35, 34 or something? 35, 34. So still it is 35, 34, 35, 29. So it is still remain better. It is still remain better. Okay. Thank you. Thank you for that. That's the correct one. I don't see any other question. I want to explain another one concept. Remember all the time that you've done the money market, the forward contract hedge. Remember, I said futures and forward, but I have decided to concentrate on forward so that we understand before I explain the futures. And I want to give the last part of the forward. I want to explain the other part of the forward because in all these questions we are given the forward exchange rate. But forward exchange rate is not just something that comes from Bruce. It will come from some factors, some economic factors like inflation, the purchasing power. You know that when a country is facing high inflation, it is likely to lose its purchasing power. The exchange rate is affected by the purchasing power. And I want us to write today's lesson by explaining forward exchange rate using inflation rate, the purchasing power parity theory. The purchasing power parity theory should help us to understand what it means if you are given the spot exchange rate between Kenya and Rwanda, between Kenya and Uganda, between Tanzania and Rwanda, between Tanzania and Uganda. The issue of inflation in these countries is a key factor in determining the inflation rate, but it is not the only factor. Note it is a key factor, but not the only factor. There are other factors. Forward exchange rate using inflation rates. We say that this can be explained by applying what we call the purchasing power parity theory, which attempt to explain changes in exchange rate exclusively based on inflation rate differences between countries. Based on inflation rate differences between countries. According to the purchasing power parity theory, the exchange value of a foreign currency depends on the relative purchasing power of each currency in its respective country. Therefore, spot exchange rates will vary over time according to the relative price level changes driven by inflation. If we have the exchange rate today, and this exchange rate and the countries are faced by different inflation rate, it means that the inflation rate will affect the future exchange rate. The relationship between the exchange rate or the expected exchange rate, is given by the exchange rate now multiplied by 1 plus inflation rate in the foreign country divided by 1 plus inflation rate in the domestic country. This is what we need to understand. This one. ST, we say that it is the expected spot rate at time 0 the foreign exchange rate. S naught is the current spot rate, domestic currency per unit of foreign currency. And IF is the expected inflation rate in the foreign country, expressed, of course, as a decimal. Then IK is the expected inflation in the home country, again expressed as a decimal, because we are adding. That is the formula. If you're given the inflation rates for different countries, you are supposed to use them to determine the exchange rate in the future if you have the spot exchange rate. How do we interpret this? We say that if the inflation rate in one country is higher than in another, the value of its currency will tend to depreciate. It will tend to weaken against the other country currency. So if the country wants to manage its exchange rate, it should work on the inflation rate as well. In practice, exchange rates tend to move towards purchasing power parity, that variation over the long term, although in the short term, other factors like interest rate, trade flows, capital movement may cause deviation. I wanted you to understand that part so that you know that in case you are told to give your explanation, you are told to give your explanation between inflation rate and the spot exchange rate, between inflation rate, okay, between spot exchange rate and forward exchange rate, given inflation rate, you should be able to explain that. I want to see whether someone has a question. Ask a question. I want to give you a small illustration. Let me give you a small illustration so that at least we can wind up. Let me get an illustration. Look at this small illustration. The question reads, we want to look at the forecasting exchange rate between Kenya shillings and Rwandan francs. Let us assume the following. Current spot exchange rate, Kenya shilling to Rwandan francs. 1 Kenya shilling is equal to 9 Rwandan francs. Expected inflation rate in Kenya, which I have taken as the home country, is 8%. Expected inflation in Rwanda, which is the foreign country, is 4%. Required, determine the 1 year forward exchange rate. Determine the 1 year forward exchange rate. We need to look at it from this perspective. Look at it this way. We say that, let me just pick this one. And always I have identified this, or I have stated this, as Kenya is the home country, Rwanda is the foreign country, so that we get it from that perspective. Now, let's say that the forward exchange rate is equal to spot exchange rate. We multiply by 1 plus foreign inflation. Foreign inflation rate. Foreign inflation rate. Then you divide by 1 plus domestic inflation rate. Inflation rate. Domestic inflation rate. This should be divided by this is spot exchange rate. Can someone give me the figure from this illustration? Please give me the answer from this illustration. Just give me the answer. Someone to give the answer so that I can explain this fact and you understand it well. $8.66. In PPP, the spot rate is quoted direct. It can't be quoted indirect. Okay. I don't know. Okay. Can you compute? Someone is saying, why do not you share the notes and working after every session? Maybe you don't have them. I said the notes every day, so just get them from the coordinator. I don't have your contact. How would I send to you without your contact? I send to those I have contact, and I also send them to the coordinator. So there's nothing I can do beyond that. I don't have your contact, and you have the contact of the coordinator. You should get them from there. So let's try to get this forward exchange rate. Let me call it 1 year. 1 year forward exchange rate is equal to the spot exchange rate, which is 9, multiplied by 1 plus, we are in Kenya, so the foreign is Rwanda, 0.04. like that. Then we divide by 1 plus the home country is Kenya 0.08. I have it this way. How much is 8? Someone give me this one so that I can explain the concept. I want you to understand this concept very well. I want you to understand this concept. Someone to give me this. $8.66. $8.66. $8.66. That is what I see from a majority of you. So we just put it as 8.66 or 8.67. 67. Let me explain this. Note that at the start of the year, the exchange rate is 9 Rwandan francs, 9 to Kenya shillings. Since the inflation in Kenya is higher than inflation in Rwanda, the Rwandan francs is gaining against the Kenya shillings. This means that inflation is a contributor towards the weakening of a currency. And I would want to give you a real case. Because you are accountants. If you looked at the way in the last 2 years, the way Kenya shillings has gained against the dollar, Kenya shillings has maintained a certain exchange rate, and it has gained because Kenya has tried to work on the inflation. And I'll give an example. In 2022, I was given an assignment, or I participated in the interpretation of in the analysis of the Kenyan inflation rate. And we gave a lot of reports and a lot of data analysis about the inflation in East Africa. The government, from a point of information, took the action. Of course, inflation was among of them, among the things that were considered, but the government dealt with the inflation. And this is what has made Kenyan shilling to gain that, to gain over the last 2 years. If you look at the Rwandan currency, the inflation has maintained, remained high. That one has affected that slight change in exchange rate. So inflation is a very big factor when it comes to exchange rate. And always know that we use the purchasing power parity, the ability to buy, the power to buy, to determine the likelihood that the country currency will gain or will lose. And with those few or many remarks, I want to leave it there. Our next lesson, we will wind up the retro thing that is remaining, and we will also look at the past paper questions. Then from there, we'll move to the next things. We are moving on well, and I hope you know that the exam is approaching at a very high speed. Let us stop there. Have a great evening. See you next time.